So you treat it like a rollover. So the $1 million gets issued in a check, made out to your IRA directly and deposited into your IRA. No, not a taxable event. Now that money lives inside of your own IRA. Now what do you do with it? Well, you can have a planned conversion strategy. So now let's look at we've got a lot of stuff going on in here. Let's look at our buckets. Remember, you've got your taxable bucket. We talked about that last week, so I'm not going to go over that again. You've got your tax deferred bucket. And then you have your tax-free bucket. And last week we talked about, the first week we talked about Roth. Last week we talked about cash value life insurance, or what some people call life insurance retirement plan. But today we're talking about pensions. So basically you end up with your pension sitting in this tax-deferred bucket in an IRA. So now that $1 million sits here. Now you can say, all right, over the next X number of years, I'm going to transfer that $1 million from my tax-deferred, my traditional IRA, to my Roth IRA. And yes, I'm going to pay tax on that transfer. And let's just say, to keep it easy, you move $150,000 a year. And how do you determine that $150,000 a year? Well, as I said before, you do a calculation based on the tax that you want to pay, the tax that you're willing to pay for that conversion. And you get to choose that as we sit today under the rules. You get to choose that tax by filling up that. I'm not going to draw it again. It's over here somewhere. Let me find it. Here we are. You get to fill it up using this kind of, David McKnight refers to it as the graduated cylinder. You figure out how much you want to convert that builds up into your tax bracket. We typically recommend up to the top of the 24% bracket, but sometimes it makes sense to go a little bit further than that. But that's an individual decision. So you figure out how much of that pension you want to convert to a Roth IRA, and you choose your tax rate. And you can still do that today. So let's find our buckets again for today. Where do we go? All right. So if we did $150,000 a year, factor in some growth, maybe you're done in 8 years. Now that $1 million plus some growth, so maybe it's let's just use the same number. $1.5 million sits over here. Well, that's great. You've paid your tax along the way. Now you've got your $1 million over here. Let's not be as aggressive with the growth. Let's say, let's just call it 1.2 million. That's fine. It doesn't matter. It may grow by 50% over that period of time. Yeah, it certainly could. Yeah. So, okay. Or 1.5 million. Who cares? This is just an example. So 1.2 or 1.5 million, whatever that growth is, now that comes out. And what's the tax rate on that? That tax rate is 0. But wait a minute, Mark, doesn't matter. Now that's subject to market fluctuation. You just said it could be 1.2 or 1.5 million. I could start with 1.5 million. It could go to 1.2 million. You could create your own lifetime income pension. You, of course, want it to be tax-free. Ideally, you want it to live in a Roth. You can start in an IRA, and you can transfer it via conversion to a Roth IRA. But now you own that pension. You have responsibility for it. You can structure it how you'd like, and you can now have tax-free income. So it's not going to be, it's still going to be subject potentially to the erosion of inflation, but certainly not for tax. You know what the tax rate you paid. You've locked in that tax rate for the rest of your life, plus 10 years actually. So the rest of your life plus at least 10 years. So if you pass that to a non-eligible designated beneficiary, remember they have to distribute that by the end of 10 years. So you've locked in your tax rate for the rest of your life plus 10 years under the current rules. So if you wanted to recreate your own pension, what you would do is you take this $1 million that you start with and you put it into an annuity platform that allows for, this is very important, that allows for Roth conversions. Now, my friend David McKnight calls these piecemeal Roth conversions, which means you could take a portion every year and convert it and still stay within that annuity contract. The benefit of the annuity contract is that it should have guaranteed income, guaranteed lifetime income. Now, ideally, you also want the ability for that income to increase. So ideally, you'd look for a platform that has not just guaranteed lifetime income, not just the allowance of Roth conversions over a period of time, but also the ability for income to increase. And there are those companies out there. I'm not going to talk about the details right now, but that's how you set up your own pension that is tax-free, guaranteed for life and all that. And you still have the same options. You don't have the multitude of options that you have in a pension. Sometimes you can, if you're married, you can have these distributions, these guaranteed distributions being over single lifetime or joint lifetime, whatever works for you. There can also be death benefits involved and long-term care provisions involved, things like that. But in the simplest form, you want to take control of that pension and you want it to be, you want to move it from forever taxed to never taxed or never taxed again. You want that guaranteed lifetime income to be in place, and you're kind of just replacing something that is going to be again forever taxed with something that is going to be never taxed again. But you have that guaranteed lifetime income. Again, make sure you have guaranteed lifetime income. Make sure you have the ability. Here it is. Possibility of increasing annual income, very, very important. But pay attention to fees. When you're talking about annuities, you have to pay attention to fees. Ideally, you want the fee to be 0% or very low. There are those out there, again, devil's in the details. You have to look at the details of it. But that's where we are. That's how you handle a pension. And if you effectively transfer that pension over to your Roth IRA, then of course, anything that comes out of there is zero tax. Now, if we look back on what we did last week, we go over here. So let's build our case here. We had, we started with Roth. So we transferred our IRA and we have our Roth and we have our LIRP or cash value life insurance. And anything that comes out of the Roth up here on the right, or whether it's down on the left, I'm moving you around all over. I apologize. This board's getting complex as we go through this. There you go. Here's our first step. We convert it into the Roth. Again, that's 0% tax. We may be able to leave a balance in here in the IRA depending on the individual. Certainly not if you have a pension. So this will help. If you have a pension and you convert it to a lump sum, you may be able to leave a portion of that in the IRA and pay no tax. And if that's the case and you don't pay any tax out of the traditional IRA, we made some adjustments in the taxable bucket here where we move that over to a cash value life insurance policy or life insurance retirement plan. Any distributions out of that cash value life insurance or life insurance retirement plan, as long as they're structured properly, are 0% tax, whether it's a death benefit, whether withdrawals that you use during your retirement years or for long-term care. So we have zero tax out of your IRA. We have zero tax out of your Roth. We have zero tax out of your life insurance. So the only thing that's left, folks, so zero here, zero here, zero here, is Social Security. Social Security, as you can see over here, I'm going to give you a little preview for next week. Can you see that? I want to make this a little larger. This is what's called the provisional income calculations. These calculations and these brackets have not changed in many, many years. I'm not sure the last time it was changed, but they do not change. They're not based. They're not adjusted for inflation. So if you're married filing jointly, if you're provisional income, we're going to talk about what that is next week, is over $45,000 or $44,000, $44,000, up to 85% of your Social Security is subject to tax. If you're a single filer and you're above $34,000, up to 85% of your Social Security is subject to tax. And next week, we're going to talk about how to tackle that Social Security taxation. Whew. Okay. So we've said a lot. We've covered pensions. We've covered taxable accounts. We've covered IRAs and Roth IRAs and retirement plans, and we are at the end of our time today. I hope that was beneficial. I hope you learned something today. watch this series again. If you have questions, if you have questions, you can first of all look at our videos on attleborowealth.com, so you find it under education and resources. And if you have questions, you can email us at questions@attleborowealth.com. If you have questions or you want to schedule time with me, you can do so by emailing questions@attleborowealth.com. Again, I hope that was really helpful, and I hope this help builds on your knowledge base. And that's it for this week. We'll see you next week, right back here Tuesday morning at 10 o'clock. Have a great week, everybody. See you soon. Bye-bye.